Right now, while you're scrolling through your feed, something is happening in the silver market that almost no one in the mainstream wants you to see. Not next week, not some time down the road. Today. And if you're not paying attention, you might wake up one day and find the price has already moved without you. The reason why is going to surprise you more than you think. Before we go further, I want to ask you something. What time are you watching this right now? Drop it in the comments because I love seeing how spread out this community really is across the globe. And listen, if you want to stay ahead of what's happening in markets like this, hit that subscribe button right now. It takes 2 seconds, and it means you won't miss the next update when things start moving fast. Trust me, you'll want to be in the loop. Here's what everyone is whispering about, but not saying out loud. China has been scooping up enormous amounts of silver, and the price they're paying locally is running at a premium that makes the rest of the world's market look completely disconnected. Now, the real question isn't whether they're buying. That part is clear. The real question is, why are they buying so aggressively, and what happens next if this isn't just about industrial use, but something bigger, something tied to currency and monetary strategy? Because there's a theory that keeps coming back every time currencies start getting shaky. What if they decide to back the yuan with something real, something tangible? Now, I'm not saying that's a guarantee. In fact, I'm going to push back on the overly simple version of that idea in just a moment. But what I am saying is this. When a major country starts pulling in a strategic metal at this pace, and when the price in their own market starts separating from the global price, you don't brush that off. You lean in. You ask who's feeling pressure, who's cornered, and who's quietly getting ready for what comes next. So in this breakdown, I'm going to walk you through what's actually happening with silver step by step. We're going to talk about the price action first, and why the recent swings don't mean the move is over, even though the loudest voices keep screaming that we've hit a top. Then, we're going to dig into what physical tightness really looks like in plain language, and how you can tell when the paper market is starting to lose its grip. After that, we'll connect the dots to the currency angle, the yuan, the dollar, and the chessboard that retail investors aren't usually encouraged to think about. And stick with me because, near the end, I'm going to lay out the one scenario that could make silver's next move feel completely unfair. The kind of move that makes people say the market is rigged. Because it is, just not always in the way you think. All right, let's start with what you've probably already noticed. Silver has been moving like it's had way too much caffeine and decided to test gravity. Big rallies, sudden pullbacks, then another push higher. And every single time that happens, the same cycle plays out. Someone posts a chart, slaps a dramatic headline on it, and declares the run is finished. That's it. Top is in. Sell before you lose your shirt. You've seen it. I've seen it. And the funny thing is, the market doesn't care about their certainty at all. Here's what actually matters. Not the drama, but the structure underneath. When a market tops for real, it doesn't just get choppy, it loses its bid. Buyers back away, and rallies get sold into hard. But when a market is being driven by real-world demand, you can still get volatility and have a floor under it because actual users and long-term accumulators show up on dips like it's a fire sale. So when you look at the past few weeks, the better question isn't, did it swing around? The better question is, did it actually break? And for silver, the answer so far has been no. Every hit has found buyers faster than the doom crowd expected. That's the first clue. Now, the second clue is in the story being pushed to explain the swings. This is where you need to stay sharp. There's always a clean narrative offered right when emotions are running hot. An index gets rebalanced. A fund rolls its positions. Some big institution shifts its weightings. And suddenly the takeaway becomes brace yourself because a tidal wave of selling is about to hit. Let me be very clear. Scheduled flows can absolutely move markets short term. That's real. But what happens every time is the narrative gets weaponized. It gets used like a megaphone to scare the exact people who tend to buy at the wrong time and sell at the wrong time. The story becomes bigger than the actual event. The event is a pebble. The story is a boulder aimed right at your confidence. And here's the trick. When you hear a warning that sounds urgent, ask yourself, urgent for who? If the warning is everywhere, if it's aimed at retail investors, and if it's delivered with that smug certainty, it's usually not for your protection. It's to shape your behavior. Because when everyday people buy physical silver, that metal isn't sitting inside someone else's game anymore. It's not earning them a fee. It's not easily rehypothecated. It's not a number on a screen they can multiply with leverage. It's a real object that has to be sourced, moved, and delivered. And when enough people do that, the whole paper structure starts to get uncomfortable. So yes, you're going to hear about selling pressure. You're going to hear about inevitable corrections. And you should absolutely respect risk. But you should not let other people's fear campaign become your financial strategy. Now let's talk about the China piece, because this is where it gets really interesting. Here's a detail that matters. Silver has a deep monetary memory in China. For centuries, it actually functioned as everyday money, and that cultural reflex around storing value doesn't just vanish because the financial system modernized. Add to that the industrial reality. Silver is still a critical conductor in high-end electronics, and it's used across energy infrastructure where performance actually matters. According to the latest publicly available data and recent trade reports, silver-bearing concentrates and refined flows into China have stayed elevated even as other imports cooled off. That suggests planning, not panic. When a buyer acts like that, they're securing continuity. That's why the premium matters so much. And that also explains why you can see shortages pop up in strange places first. Smaller bars, niche components, delivery windows that suddenly stretch out, and sudden jumps in local premiums overnight. In China, the domestic silver price has been trading above the outside price by a premium that is not normal at all. And when you see a big premium like that, it's basically the market screaming, "We want the metal here now." That premium acts like a magnet. It pulls supply. It creates arbitrage opportunities. It tells you there's a mismatch between what people can click and buy in the West and what people are willing to pay where the metal actually needs to land. Based on recently published numbers and market updates, there are clear signs that physical demand has been intense, with local pricing repeatedly signaling tightness. And it's not just investment demand driving this. A lot of silver demand is industrial. Electronics, power systems, soldering, chemical applications, and yes, solar manufacturing. Silver isn't some cute collectible. It's a utility metal that happens to have money history baked into it. But here's the twist most people miss. Industrial demand doesn't need to be wildly bullish for the price to explode. Industrial demand just needs to be stubborn. If the world has built systems that require silver and the supply can't respond quickly, you get a squeeze dynamic. And when you layer investment demand on top of that, the market can move faster than logic would suggest because the supply chain is slow and the paper market is leveraged. Now, some people hear China is buying and immediately jump to they're going to back the yuan with silver. Slow down. That's the part of the story that can turn into pure fantasy if you don't think it through carefully. Backing a currency with a metal isn't like flipping a switch. It's not just we bought bars. Now the currency is hard. Real backing requires credibility, transparency, redemption mechanisms, and a willingness to give up control over money supply. And most governments really don't like giving up control over money supply. They like the ability to stimulate, to bail out, to smooth over pain, to paper over cracks. Metal backing is discipline, and discipline is politically expensive. So I'm skeptical of the meme version of a silver-backed yuan, not because it's impossible in theory, but because in practice it comes with trade-offs that most policymakers avoid like the plague. But here's where I'm not skeptical at all. A country can still use silver strategically without promising full convertibility. They can stockpile. They can encourage domestic ownership. They can use it in bilateral trade arrangements. They can use it to support confidence indirectly. They can treat it like a strategic input the same way energy reserves and food reserves are treated. And if they do that, the market impact can still be absolutely massive even without some big headline declaration. So instead of asking, will they back the yuan, ask this. Are they trying to reduce vulnerability to the dollar system? That's the real frame here, because the dollar system isn't just about currency. It's about settlement rails, sanctions risk, payment messaging, and the ability to freeze or block transactions. If you're a major country and you don't like that vulnerability, you diversify. You build alternatives. You hold assets that aren't someone else's liability. And silver, historically, has been exactly that kind of asset. It's not tied to one issuer. It's not a promise to pay. It's a thing. Now let's zoom back to the price action and do something most people won't do. Compare today's behavior to past blow-off tops without getting hypnotized by exact pattern matching. When silver peaked in past eras, it tended to surge and then collapse quickly, because the move was mostly speculative and the market couldn't absorb the selling once momentum broke. But in a move driven by physical tightness, the pullbacks can be sharp and still get bought because users and long-term accumulators treat dips as supply opportunities. The key is what happens after the spike. Do we get follow-through selling that lasts, or do we see stabilization above key levels? The fact that we've seen buyers show up repeatedly suggests we're dealing with a different kind of market than a pure mania blow-off. And that doesn't mean it can't correct. It can. It will. Nothing goes straight up forever. But the corrections in structurally tight markets tend to be violent, short, and frustrating. They're designed to shake you out and then continue without you. That's why I keep saying, don't base your decision on vibes. Base it on structure and fundamentals. So what are the fundamentals that actually matter right now? 1, physical availability versus paper claims. If paper claims to silver keep expanding while deliverable supply gets tighter, you have a pressure cooker. It doesn't explode every day. It builds. And then one day, it doesn't matter how confident the commentators sound, the price gaps because the metal is actually needed. 2, leasing and near-term tightness signals. When people are willing to pay extra to get metal now rather than later, that's a tell. It's not the only tell, but it's one of the cleaner ones. It means the market is putting a price on immediacy. 3, inventories that can actually be delivered. Not total stocks, not theoretical availability, but what can be moved against obligations. When that number shrinks relative to promises, the system becomes fragile. And fragility is what drives the biggest moves because markets don't price fragility smoothly. They price it suddenly. Now here's the part nobody likes hearing. High prices can hurt demand. If silver gets too expensive, solar manufacturers will find ways to use less, redesign systems, substitute materials, or delay projects. Electronics companies will optimize. That's real, and it's a reason to expect volatility. But there's another side to this. Substitution takes time. Engineering changes don't happen overnight. Supply agreements are sticky. Production lines can't just stop and restart without serious cost. So the demand response is delayed, which means you can get a window where price runs far ahead of what you'd consider comfortable for industry. This is why you're seeing stress in areas that rely heavily on silver, and it's why if China's domestic market keeps paying up, global supply will get pulled toward that premium. That can tighten availability elsewhere, which then feeds back into the price. It's a loop. If you're finding this breakdown useful, do me a favor and hit that like button. It helps more people see this kind of content. And if you've got thoughts on where this is headed, drop them in the comments. I actually read those. Now, let's bring gold into the picture because you really can't talk about monetary metals without addressing the big one. Gold has been in a long-term trend where official sector buying has been meaningful, even if the month-to-month numbers wobble around. And whenever the buying slows down a bit, the narrative instantly becomes, see, it's over. But when you look at it in value terms and you look at the broader trend of reserve diversification, it's hard to argue the underlying incentive has disappeared. Currencies are being managed aggressively everywhere. Debt levels are massive. Real purchasing power has been squeezed. And when governments and central institutions face that environment, they look for reserve assets that don't depend on someone else's promise. That's not conspiracy talk. That's basic incentives. So gold keeps its role, but silver is the wild card because it sits right at the intersection of industry and money. It can behave like a commodity and then suddenly trade like a monetary metal when confidence cracks. And when that switch flips, the move can be dramatic because the market is smaller and the inventories are thinner relative to potential demand. Now here's where we shift into the currency conversation. And I want you to pay attention because this is where most videos lose people. I'm not going to do that. I'm going to keep it simple and clear. The dollar has strength for a reason. It's used everywhere. It's liquid. It's the default settlement currency for a huge amount of trade. And the financial system is built around it. But that strength is not the same thing as stability. You can have a currency that remains dominant and still loses purchasing power steadily over time. Dominance and value are not identical concepts. So when you hear the dollar is strong, ask strong against what? Another currency that's also being managed, or strong in terms of what you can actually buy. Because most people don't live in currency pairs. They live in groceries, rent, energy, and durable goods. Now connect that to China. If China is trying to reduce reliance on the dollar system, they don't have to dethrone the dollar overnight. They just have to build optionality. They have to increase their ability to settle trade in other units, hold reserves in other forms, and reduce exposure to dollar-centric choke points. And metals fit right into that strategy as a neutral reserve. Right now, something is happening in the silver market that almost no one wants you to see. And if you're not paying attention, you might wake up one day and find the price has already moved without you. Before we go further, drop in the comments what time you're watching this, and hit that subscribe button right now so you don't miss the next update when things start moving fast. Here's what everyone is whispering about. China has been scooping up enormous amounts of silver, and the price they are paying locally is running at a premium that makes the rest of the world as market look completely disconnected. The real question is, why are they buying so aggressively? And what happens next if this isn't just about industrial use, but something tied to currency strategy? If the domestic premium in China persists, and global inventories that matter for delivery continue to tighten, you could see a situation where the price discovered in paper markets becomes less relevant to the physical market. When that happens, you get gaps and sudden repricing, because the physical market forces the paper market to catch up. Now, before you get excited, markets can stay volatile for longer than you'd like, and hype can destroy you if you size positions wrong. Here's the skeptical perspective. China's buying could be less about monetary strategy and more about industrial planning and supply chain management. If you're a manufacturing-heavy economy with massive exposure to silver inputs, you might want to secure supply. And that matters, because if the buying is purely industrial, it might be price-sensitive, so don't marry a single narrative. Watch behavior, watch premiums, watch delivery signals. Watch whether the talk of substitution actually reduces physical tightness, or whether it was mostly talk while the metal keeps disappearing. When people demand physical delivery, supply chains get tested, mints get backlogged, dealers widen spreads, delivery times stretch out, and premiums can decouple from spot price. That's a clue you're not in a normal market anymore. If you're thinking, what do I actually do here? First decide what game you're playing. Are you trading or building a position? If you're trading, you need risk controls, and you have to accept you'll be wrong sometimes. If you're building a position, you care about accumulation zones and not getting shaken out by noise. Most people confuse the two. They say they're long-term, then panic, sell a dip. That mismatch is where accounts go to die. Now the currency portion. A lot of people think oil is priced in dollars, therefore dollars are valuable. There's truth in that, but it's incomplete. The real driver of dollar value over time is supply relative to demand for holding it. If the supply of dollars expands faster than the desire to hold dollars, the value erodes, and that pushes up the dollar price of scarce things. Imagine a world where energy trade becomes more flexible in settlement. Even small shifts can matter. If more trade can settle in other units, the automatic demand for dollars can weaken at the edges. That doesn't crash the dollar overnight. It just changes the slope, and metals respond to slope changes. When you see China accumulating silver, consider the bigger context. Multipolar trade settlement, diversification of reserves, and the attempt by major players to reduce dependence on a single system. If the dollar remains dominant but real rates fall and liquidity ramps up, you get the worst combination for cash savers. The currency stays strong in headlines while your purchasing power bleeds out quietly. Use ratio thinking. Compare silver to gold. Compare silver to oil. Ratios tell you whether something is expensive or cheap relative to another scarce asset. The silver to gold ratio swings wildly, and those swings often reflect stress in the system. Is this move fake? Is it just speculators? There is absolutely speculative activity. But the presence of speculation doesn't mean the whole move is fake. The difference is whether speculation is riding on top of real tightness or whether it's the entire foundation. If the foundation is tightness, pullbacks get bought. If it's pure hype, pullbacks become avalanches. If China is buying, does that mean everyone should rush into silver? No. Rush is how people lose money. If you want exposure, build it thoughtfully. Use scaling. Don't let a headline force you into an emotional trade. Drop in the comments. Do you think China's silver buying is mostly industrial stocking or part of a bigger monetary strategy? What about stocks tied to silver? Miners, streaming companies? Those can move harder than the metal itself. They can also disappoint because costs, energy inputs, labor, politics, and management all matter. Don't treat it like a simple leverage button. Real rates and liquidity matter. When the return on cash and bonds doesn't keep up with inflation, you're paying a tax for holding safe assets. And when that happens, people look elsewhere. That environment supports hard assets, not because they're magic, but because the alternative is a guaranteed slow loss. There's currency as a payment tool and currency as a store of value. Many currencies function fine as payment tools, but being a store of value is harder because it requires restraint and trust. If China wants the yuan to play a bigger role internationally, it needs other countries to be comfortable holding it. Silver and gold stockpiling can contribute to that perception. The demand profile for silver has changed. Electrification is real, grid upgrades are real, data centers are real, and many systems use silver in ways that are hard to substitute. At the same time, new supply is not easy to bring online. Most silver is produced as a byproduct of other mining, so when you get a demand shock, the market solves it with price. What if I buy and it drops tomorrow? It can, it might. And if your plan can't survive a drop, your plan isn't a plan, it's a hope. Think in terms of tranches. Decide ahead of time. Don't decide in the middle of panic. Reality check about paper suppression. Yes, the paper market can influence price discovery. Yes, leverage exists. But not every down move is a conspiracy. Focus on what can't be faked easily. Delivery stress, persistent premiums, behavior of physical users. Silver is not moving in a vacuum. It's moving in a world where supply chains are stressed, industrial usage is massive, and trust in paper promises is not what it used to be. When China's domestic market pays a big premium, that's a loud message about real demand and urgency. The Yuan question is not about some fairy tale silver standard. It's about how countries reduce dependence on a system that can be used as leverage against them. Final thought. The most explosive moves in silver don't happen when everyone is excited. They happen when people get bored, when volatility shakes them out, when the crowd declares it's over. Then the market rips higher because the underlying tightness never left. Watch the premiums. Watch the delivery signals. Watch the dips. Don't let loud voices trade your account for you. Drop a comment with what you're watching most closely in silver right now. And hit that subscribe button.